What is gross profit for franchise owners? Have you ever wondered how franchise owners determine their financial success? One key element in that equation is gross profit. So, what exactly is gross profit for franchise owners? Gross profit is the amount of money left over from franchise revenue after subtracting the direct costs associated with producing goods or delivering services. These direct costs are known as cost of goods sold. They include expenses like the purchase price of products, ingredients, packaging, and direct labor involved in production. To put it simply, gross profit does not include other operating expenses such as rent, marketing, royalties, or administrative costs. The formula for calculating gross profit is straightforward. Gross profit equals revenue minus cost of goods sold. For example, if a franchise unit generates $500,000 in sales and the direct costs total $300,000, the gross profit would be $200,000. Understanding gross profit is essential for franchise owners. It shows how efficiently the franchise generates income from its core business activities before considering overhead and other operating expenses. This figure serves as a key indicator of the franchise's operational profitability. It helps owners assess pricing, cost control, and product mix. In the world of franchise ownership, gross profit is a vital metric. It reflects the financial health of the franchise unit's core operations and indicates the ability to cover fixed costs such as franchise fees, royalties, rent, and salaries. Additionally, it provides a basis for calculating other profitability measures like net profit and return on investment. Franchise owners can also use gross profit to compare performance across units or against industry benchmarks. However, it is important to note that gross profit margins can vary widely depending on the type of franchise, the product or service offered, and local market conditions. For instance, a food franchise may have different direct costs and gross profit margins than a service-based franchise. Practical applications for franchise owners include regularly monitoring gross profit to identify trends or issues in cost management. They can use gross profit data to negotiate better supply costs or improve operational efficiency. Incorporating gross profit figures into financial planning and forecasting is also beneficial. Furthermore, comparing gross profit margins with franchisor benchmarks can help evaluate unit performance. In summary, gross profit for franchise owners is the revenue left after subtracting the direct costs of goods or services sold. It is a foundational profitability metric that informs many aspects of franchise financial management and decision-making. Understanding this concept can significantly impact the success of a franchise operation.